Hi everyone, welcome to my YouTube channel, and I'm Chia. This is Introduction to Financial Accounting Part 2. Right, thank you for watching. So this introduction is very simple, and if you have already done this topic before, you can actually skip this. Right, it's targeted mainly at students who might be doing this at degree level or diploma level, and they have difficulty in understanding accounting equation and how are transactions analyzed. So this is very relevant if you have issues with your basics and foundation. Right, the scope for today is that, continuing from the last video, we are going to look at how do we apply the accounting equation in more complex transactions. So that's the objective of today. Then towards the end, we are going to summarize what the major item classes used in financial accounting, and we have the closure. So let's have a quick refresher on what we did the last time. In the previous video, we have covered the use of accounting equation in somewhat simple transactions, such as purchase of goods, additional capital from the owner, right? And we have also identified that the accounting equation should be in the form of assets equals to capital plus liability. Now we also have learned from the previous video that this equation can be further modified by rearranging the items like this, for example, and then you could derive a new equation that says, for example, asset minus liabilities equals to capital, right? You also can rearrange in another way, by shifting for example, the assets to the right, and then you have something else, right? So you might be able to derive something like, say, assets minus capital, and that would give you liability. So the equation can be manipulated, adjusted in any way, and that can help you to find, for example, missing things like liability values or asset values. And to add also, you might have also read from certain books that in the equation we may not use capital. Yes, you're right, in some cases the term equity is used in place of capital, but they mean the same anyway. Okay, so now what we're going to do is that we're going to look at the more complex applications of accounting equation, right? The more complicated transactions. How do we analyze them? Let's have a look at the following example, right? So in this example, we understand that other than capital, assets and liabilities, it's possible for the business to generate revenues. For example, Peter earned interest income of $10 on 10th of January. Now, so if we are going to look at the accounting equation, which is asset equals to liability plus capital, then how would this this interest transaction be analyzed? What is the impact? Okay, so Peter has earned certain amounts of interest income, right? Has he received this interest income? Okay, we assume that he has received. Okay, to make it simple. So which means that Peter should find that he has additional cash of $10, and the reason why this has occurred is because he has earned interest income. But wait, this interest income is not a liability. This interest income is actually a form of revenue. Now there is a slight problem, because in this equation there is actually no classification for revenue. What do you do? Okay, so now let me introduce to you one more thing. In the accounting equation, there is an additional portion for profits and losses. Now a business is able to make profits and losses, and this profits and losses is calculated by taking revenues minus expenses, right? So this portion here determines how much profits are made, and this profits or losses is belonging to the owner, or is borne by the owner if it's a loss. So with this equation, then life is simpler, because now we can tell that, okay, there is $10 of cash that is received, and that there is also revenues received of $10. Now in this case, have you realized that the equation is balanced. Do you realize that? It is balanced. Why is it balanced? Because this transaction has two effects. It has an effect on assets of $10. It also has effect on revenues of $10 on both sides. So therefore the equation is equal on both sides. Equation is balanced. So that wasn't so bad. Right, let's look at something even more interesting. What happens if, let's say, there was no income? There was no interest income, there was instead interest expenses. How would the interest expenses affect the accounting equation? Well, if you remember the equation earlier on, the accounting equation, which I mentioned to you, can be expanded. Right, asset equals to liabilities plus capital, and now adding one more component, which is the profit or loss component, revenue minus expenses. Let's observe. So there is more expenses, and we assume that these expenses are paid. So we find that as a result there are less cash on hand. Okay, the left side of the equation is now lesser, and we find that there are also more expenses. Expenses are higher, right? And notice that this transaction has two effects. One effect is on the cash balance, the other is that it is an expense. So both sides of the equation has decreased equally by $10, right? And the equation still balances. Notice that this is a bit more complicated than the earlier video, the examples in the earlier video. Let's look at something a bit different. How about this? Now I'm going to explain to you what happens if, let's say, Peter sold goods of 200. Now these goods were sold for 200, and that was the selling price. Now, and the cost price of the goods was $120. Question: what is the effect on the accounting equation? Okay, so we have the equation here again. Asset equals liability plus capital. In this case, we need to have another component for profits or losses, which is calculated by taking revenues minus expenses. What is the effect? Okay, one point of view is that some people might treat this as there are lesser stocks. Yep, you're right, there are lesser stocks. Or lesser inventories of 120. No, and this also means that the business, by taking out its stocks to sell, it has also generated revenues of 200. Now this 200 can be in the form of cash collections. Let's assume that it is paid up in full. Assume that the customer has paid up the 200. Now notice that the equation doesn't balance now, because this side of the equation you have an increase or a positive net 80. What about on the right hand side? Actually, on the right hand side there is also an increase of 80. Why? Because the business made profits from the sale of goods. Goods cost 120 and these were sold for 200, so there were profits made. Right. So how do we show this on the right hand side of the accounting equation? Simple, right? So you find that there are revenues of 200, expenses of 120. The expenses, as in the cost of buying the goods, was 120. So the equation is still balanced on both sides, left and right. Okay. Now, so that was my example just now. What happens if, let's say, these were now sold at cost? Let's just assume. If these are sold at cost, what will happen to the accounting equation? Could you imagine what will happen? Okay, so I have my equation here written up again. Okay, so now you know the goods were bought at 120 and these were sold for 120. Let's observe. You'll find that the stocks or the inventories on hand would decrease by 120, assuming if the customer has paid out everything in full by cash. You find that the cash collection is only 120. So that gives you an effect of 0 on the asset side of the equation. What about the right hand side? There are revenues of 120 because these were sold for 120. Costs of these goods was 120. So this gives you a net effect of 0. Now notice the rule here is that the accounting equation is always balanced after any kind of transaction, right? And the effect is always equal on the left and right. The total effect on the left and total effect on the right must always be equal. So did you realize something? What is the effect on inventories? Right? The effect on inventories when there is a purchase or sale is that inventories either increase or decreases. You realize that when we sell off these goods, inventories actually get decreased, right? When you purchase more goods, then you find that there are greater inventories of goods, right? So that is how you should reason the effect of transactions, right? Does it sound right? Well, when we move on to double entry, then this will be even more interesting. Just bear this in mind. Important. Right? Going on. So let's look at purchase and sale of goods. Right? So John is a sole proprietor. On 1st January 2015, he bought goods of 300 and he paid for all these by cash. And then on 15th January, he sold all these groceries for 500. Analyze the effect of the two transactions on the accounting equation. Let's begin. So on 1st January, so there are two things that we are going to do. One is the recording of the transaction. Asset equals to liability plus capital plus the profit, which is revenue, minus expenses. So in this case, there are more groceries that were bought. You find that there is an increase in inventory, but at the same time there is a drop in cash balance because of the payment. So there is zero effect on the asset side of the equation. There is also no effect on the right hand side of the equation. Equation balances. Now come to the 15th, things are a bit more interesting. Why is it more interesting? Because on 15th January, right, John, he sold off all the groceries for 500, so there were no more inventories. All were sold, and then in return he has received $500 of cash, right? So if you look on at the right hand side of the equation, right, what is the effect? The effect is that firstly, there are more revenues of 500. What about the expenses? Yes, there is also some expenses. Why? Because the goods did cost John something to buy, right? It cost John 300 to buy these goods. So the left hand side of the equation, observe an increase of 200, whereas the right hand side, you observe that there is a profit of 200. Now how did this 200 of profit arise? Because John managed to sell the goods for 500 and these goods cost him 300, right? So notice that the equation still balances on both sides. Quite simple. Now, and in practice, how do we recognize the movement of inventories? How do we ensure that this is properly recognized? Now, there are various ways to recognize the movement of inventory. Now, there is the periodic method, right? And in fact, depending on what method that is being used, this can actually affect how you analyze the accounting equation, how you analyze the effect of transactions on accounting equation. So there are generally two methods. One is the periodic method. The periodic method is quite straightforward. Basically, it recognizes that all purchase of inventory is treated as a purchase expense, right? So that means if you buy any goods, immediately it is treated as an expense. So say for example, right, so this is to clarify how we would treat the purchase of inventory in our following video. Okay, so if inventories were purchased, then you find that what happens under the periodic method is that no stock movement is recognized in the assets. However, what immediately happens is that the purchases are treated as an expense, or whatever it is. And at the same time, if let's say there is a payment made, then this is interpreted as, or this will be treated as, a decrease in cash balance if payments are made for the goods. So this is how we treat the recording of purchase of goods using the periodic method. But you notice that earlier in the in the examples that I walked you through, you realize that I have also taken into account of changes in stock balances when there is a sale of goods. Now that method that you observe is also known as the perpetual method. Now the perpetual method is not covered in this video, right? We'll come to it, but it will be much later on. So, but for a start, what we'll do is that in any of those questions that will come across in the subsequent videos, until we go through the perpetual method, we'll use this method of accounting for stock purchases. Right? So there is no adjustment for there is no need to recognize any effect on inventory values, whether there are more or less inventories. Not at all. Okay. What about if there is a sale of goods? Now under the periodic method, for the sale of goods, how we recognize this is that if there are more goods being sold and that there is cash collection, what we'll do is that we recognize that there is a cash collection, and whatever that we have sold, right, we treat it as a revenue, whatever amount it is. Whatever amount it is. Right? So this is very fundamental, and in fact, when you are going to practice a question on recording of stocks being purchased or sold, usually this is the approach that is being taken, and we do not recognize any inventory increases or decreases. Everything is just treated as either a sale, revenue, or a purchase expense. Now you might say then, what about the remaining stocks that are unsold? Okay, in the periodic method, those stocks that are left over, what we refer to as the closing stocks, these would be recorded separately. That means at the end of the month, there would be a way of finding out how much is the closing inventory, and then ensuring that these are properly recorded at month end or at year end. Okay, so that does it for the periodic method. So now what we went through, okay, we have found out that profits are calculated by taking revenues minus all expenses, right, which may include rentals, utilities, and so on. Profits belong to the owner of the business, therefore we say that aside from capital, there is also additional profits that might be belonging to the owner. If there are losses, then it will be a minus losses, if there are any. In some cases, business owners may also withdraw cash or assets for personal use. Now such drawdowns or withdrawals for personal use, note, is to be treated as drawings. Now drawings basically is the reverse of profits. Profits is what belongs to the owner. Drawings is what the business takes out from the business for personal use. Read the keyword, personal use. Now, so let's use an example to understand how this drawings is to be analyzed. So on the 15th or 31st of January, we withdrew $15 for personal use. Analyze the effect of the transaction on the accounting equation. That's very simple. Basically, there is $15 being taken out for own use, and we find that there is also drawings of $15. Right. Are both sides of the equation equal? Yes, it is. The left hand side of the equation is lesser by 15. Right hand side is also lesser by 15 because of the drawings. Right? Now this term drawings is commonly used so long as you have something about things being taken for personal use. It can be goods, it can be cash. So now we have covered the major types of item classes used in accounting. So they are namely assets, liabilities, equity, or also known as capital, and we also covered revenues and expenses. So these are the 5 main classes. Of course, equity and drawings are actually considered as one class on their own. Okay. Now the tricky thing is that as we move on to the following videos, is that you have to be aware of how purchases and sales are recorded, right? In this video, what I did was that I assumed that all purchase and sales are on cash basis, but the reality is that it can be on credit terms, right? Which means that payment may be made later, right? We also went through the concept of drawings and how drawings recognized and how does it affect the accounting equation. Right. In the following video, we would be moving on deeper into the concept of double entry accounting. Now, double entry accounting is actually derived, or rather is heavily supported by the use of accounting equations. So later on, as we move towards double entry accounting, we would discuss a bit more on the use of accounting equation to analyze transactions. Okay, so thank you for watching. So this is a very simple introduction video on the more complicated ways to utilize accounting equation. Thank you for watching and have a good day.